Hi, what if I told you there is a stock that's raised its dividend every single year since Beatles broke up? Yep, we're talking about 50 years of reliable, growing income. That stock survived inflation, recession, and even cold wars, and still yields 4% or more today. And I'm not talking about some risky REIT or energy play. I'm talking about PepsiCo. Yep, Pepsi. But there's a twist. Behind the iconic brand is the balance sheet that's starting to flash some warning signs. High debt, slowing earnings, and payout ratio is getting uncomfortable. So the big question is PepsiCo still a good dividend stock for a long haul, or it's time to pop and pour something new into your portfolio? Stay tuned, I've got all the data, answers, and the context you need without sugarcoating. So grab your drink and let's dig in. Let's kick off with the essentials. Ticker PEP, price $131, dividend yield 4.31%, and that's solid. Taking into account they just announced their raising for the next payout. Yoo-hoo! Trailing P is 1935, so less than 20, that's ideal, that's what we're looking for. Lower than its historical average. So forward P is around 16.7, even cheaper. PEG ratio is 4, almost 5 actually, 4.81. Okay, that's a bit spicy. Slower growth ahead. In plain English, Pepsi is cheaper than usual, but the expected growth is slowing, hence that bloated PEG ratio. Let's take a second to zoom out and look at the stock chart. Just 2 years ago, Pepsi was trading near 180. Today, we're looking at 131. That's a drop of about 27%, and we are close to the support line right now, which is around 128. And no, it's not normal for a stable dividend aristocrat like this. The last time Pepsi saw a drop like this was way back in 2008 during the Great Recession. Back then the stock fell from $75 to around $50, a 30% haircut. So what's the takeaway here? Either Pepsi is offering us a rare buying opportunity, or we are witnessing the early signs of something structurally broken. That's why we're digging deeper, because timing matters with dividend stocks, especially ones that rarely go on sale. So, financial fitnesses. Let's look under the hood. Revenue, $91 billion. EPS, 6.8. Free cash flow, just over 7.2 billion. So far so good, but here comes the red flags. Current ratio, 0.83. You want that overlay to be ideally more than a 1, and even better if it is 1.5. Means that they might have to scramble some pay short-term bills. Debt to 2.64. Translation: Pepsi loves borrowing more than your uncle loves fishing. Way too high. Profit margins and ROE are strong, though they're making their money work, just with a lot of borrowed cash. Okay, let's go back to the start of the show, dividends. Hey, if you're enjoying this breakdown, please hit that like button. It tells the algorithm that I'm not just talking to myself in my basement. Yield 4.31%. This is just great for a stock like this. Dividend King with such dividend yield, oh my gosh. Growth streak 53 years. Mic drop. However, payout ratio is 83%, around that. Yeah, ideally we want that under 60%, so there's a wiggle room. This one is a bit tight, like wearing skinny jeans after Thanksgiving tight. Historically, Pepsi's yield wasn't always this sweet. 5-year average is only 2.8%, so you're catching it at a rare moment. So is it safe? Kinda, but there is less margin for error. Let's throw Pepsi in the ring with its big rivals, Coca-Cola and Keurig Dr. Pepper. So P ratio, TTM is 19.4, around that. Comparing with Coca-Cola, which is 24, and Dr. Pepper 25, almost 26. Dividend yield is 4.3, comparing again with Coca-Cola, only 3%, which is not that bad either for a company like Coca-Cola, honestly. If you look historically, just like Pepsi, just keeps growing endlessly. But right now, Coca-Cola, out of this cycle that they had a downward movement in the previous years, and now they're back to all-time highs. So we are asking ourselves, will Pepsi be the next for this? And going to debt equity ratio is 2.64 for Pepsi, whether for Coca-Cola is only 1.4, and for Dr. Pepper is around 1. A dividend streak, 53 years for Pepsi, which goes on the second place. On the first, Coca-Cola with 61 years. But honestly, 53 or 61 years doesn't make a lot of difference at this point. And, well, Dr. Pepper is just a small kid at this point, 10 years of dividend streak, which is not bad at all. In 5 years, it will be already something interesting. So, what's the takeaway? Pepsi has the best current yield. Coke is more defensive. KDP is a caffeine-fueled growth play. And, well, Pepsi is basically the only one feeding your snacks to. Ever try dividend chips? They're crunchy and inflation resistant. What's new at Pepsi? 2025 was busy. They bought Poppi, prebiotic soda for almost $2 billion. Gut health is hot. Bought Siete Foods, expanding into grain-free snacks, swallowed Sabra, hummus for days. They're also ditching artificial dyes, launched Gatorade tablets a couple years ago, and partnered with AWS to turn Pepsi into a tech-powered hydration empire. Leadership-wise, new CFO, new controller, no drama, just a refresh. Quick timeout. If this video is helping you think smarter about the dividend stock investing, smash that like button. It's free and my caffeine budget depends on it. Let's not ignore the potholes. FTC lawsuits about unfair pricing practices. Profit forecast got trimmed thanks tariffs. Payout ratio is stretchier than a yoga class. Free cash flow is dipping. So yeah, not doom and gloom, but definitely keep your eyes open. So fair value around probably 145. Again, we will get the different estimations. Under 128 it's ideal to buy. Right now it's 131, as you know, so you're kind of in the middle zone, not a screaming deal. But yeah, if you zoom out, that probably is a screaming deal. But again, you don't have an ideal stock. There is always something wrong with it. But you just need to focus on long play. And of course, for me, every stock that's a dividend king that offers 4% or plus dividend without crazy black swan event, let's call it that way, is a buy. But again, it's just for me. Probably you're a different type of investor. So if you need a dividend anchor in your portfolio, Pepsi can play that role. Pepsi is a dividend legend with real staying power. 4% plus yield is really rare. The brand is rock solid. The payout track record is record gold. But the payout ratio and debt are flashing orange lights. No red, but orange. Verdict? Hold, some analysts might say. Honestly, I don't look a lot at the end what analysts say, because they are really adjusting at some point to the market conditions, whether it's hold, buy, or sell. For me, I just it's a good stock if it's time to buy a stock, ideally on a monthly or even bi-weekly basis. And Pepsi looks like it fills almost all the checkpoints for me at this point. And yet, if it drops under 128, which is kind of a support line, long line, it will be, I will load a lot of. You know the drill. This is not a financial advice. I'm not your financial advisor. I'm not an advisor at all. And I'm just a financial nerd with many spreadsheets and a deep love of free-to-play products. And of course, your financial future only depends on you. Nobody can tell you what to do and when to do it. It's your brain that you need to use. I'm just here to show you what my thinking process looks like and what I use to make those decisions. So this is for educational purposes only. If you like the video or not, regardless, just leave a comment, tell me what you think, and we can go on from there and discuss other stocks. That would be interesting. That's the whole purpose of this. It's not like whoever's right or wrong. It's really share opinions. So we can continue talking in the comment section or in other social media channels that I have. So see you in the next video. Bye.